There are rare moments in global financial markets when a single asset begins to speak louder than headlines, louder than daily volatility, and louder than the noise of speculation. Today is one of those moments. Silver is no longer moving quietly in the background. It is asserting itself at the center of a shifting macro landscape. The way it is behaving right now is forcing institutional desks to reassess assumptions they have held for years. At first glance, silver's recent strength might look like just another extension of a broader commodities rally. Prices have risen, momentum appears intact, and commentary across mainstream platforms frames it as a simple reaction to inflation expectations. But that interpretation barely scratches the surface. What is unfolding beneath the price action is far more structural, is far more calculated, and far more revealing about where capital is positioning itself next. As of today, January 14th, 2026, silver is trading at levels that were once dismissed as unrealistic targets. Yet this move has not been driven by retail enthusiasm or speculative excess. It has been shaped by a convergence of macroeconomic uncertainty, institutional flow dynamics, and supply-side constraints that are tightening in ways most traders are only beginning to notice. This is not a market being pushed forward by emotion. It is a market being guided by necessity. What makes this moment especially compelling is how calm the surface appears relative to the forces underneath. Volatility has not exploded. There has been no dramatic panic, no disorderly price action. Instead, silver has advanced methodically, absorbing selling pressure, respecting key zones, and continuing to attract interest precisely when other risk assets appear fragile. That kind of behavior tends to emerge, not at the end of cycles, but at inflection points. Part of the explanation lies in the macro backdrop. Recent U.S. economic data has continued to reflect a slowing but resilient economy. Labor market indicators are softening just enough to keep rate cut expectations alive, while inflation remains sticky enough to keep policymakers cautious. This tension has created an environment where real yields fluctuate but fail to provide a clear directional signal. And in that uncertainty, precious metals quietly regain relevance. At the same time, geopolitical risk has not receded. Global trade routes remain vulnerable, energy markets remain sensitive, and political fragmentation across major economies continues to inject instability into long-term forecasts. For institutional investors tasked with preserving capital rather than chasing returns, all assets that sit at the intersection of monetary hedging and real-world utility begin to matter more. Silver occupies that intersection uniquely. Unlike gold, silver is not merely a monetary metal. It is deeply embedded in industrial demand, particularly in solar energy, electronics, and advanced manufacturing. Structural investment into renewable infrastructure has not slowed, and that has kept baseline demand elevated even as prices rise. This creates a dynamic where pullbacks are absorbed quickly, not because traders are optimistic, but because real consumption continues regardless of market sentiment. What most short-term narratives fail to account for is how constrained supply has become relative to that demand. Years of underinvestment in mining capacity, coupled with declining ore grades and rising extraction costs, have tightened the physical market. Above-ground inventories have been drawn down quietly, without drama, and that tightening only becomes visible when price begins to reflect it. By the time headlines notice, the process is already well underway. Overlay this with institutional behavior, and the picture becomes clearer. Large funds do not chase price. They position around structure, liquidity, and probability. Silver has moved higher. It has not triggered broad liquidation. Instead, it has prompted recalibration. Exposure has shifted, hedges have been adjusted, and positioning has become more deliberate. That tells us something important about how this move is being interpreted behind closed doors. There is also the timing to consider. Early in the year, capital allocation decisions are reassessed. Portfolios are rebalanced. Risk models are updated. When an asset holds strength through that process, it sends a signal. Silver has not been treated as excess risk to be reduced. It has been treated as exposure worth maintaining. That distinction matters more than any single candle on a chart. Yet despite all of this, uncertainty remains. The market is not declaring victory. It is pausing, evaluating, and waiting for confirmation. That pause is often where the most revealing information emerges, because it exposes where liquidity rests and where conviction truly lies. And right now, the clues are subtle, but they are there. What comes next will not be determined by headlines or opinions. It will be determined by structure, by positioning, and by how price interacts with zones that most traders overlook entirely. We will step inside the chart itself and examine where liquidity is clustering, how smart money has been engineering recent moves, and why what looks like consolidation may actually be preparation for something much larger. Because when silver moves decisively from levels like these, it rarely does so without leaving a trail of intent behind it. And that trail is already forming. Previous section was about understanding why silver has reached this point. This section is about understanding how the market is actually being engineered from here. Because once price reaches historically significant zones, charts stop being about indicators and start being about intent. And intent in institutional markets is always revealed through structure and liquidity. When you strip the silver chart down to its core, one thing becomes immediately apparent. This market has not been moving impulsively. It has been moving with control. Higher highs and higher lows have been formed, but not in a way that invites public participation. Instead, each advance has been followed by deliberate pauses, shallow retracements, and tight consolidations that suggest accumulation rather than distribution. That distinction is critical because distribution leaves chaos behind. This chart leaves order. Zooming into the higher time frames, the broader market structure remains decisively bullish. Previous resistance zones that capped price for years have now flipped into support, and price is respecting them with remarkable precision. This is not accidental behavior. It suggests that large participants are defending these levels, not abandoning them. When institutions distribute, they do not defend old highs. They accumulate, they do. But the most revealing information does not sit at obvious levels. It sits just beyond them. Liquidity by nature clusters where the majority of participants place their risk. Above recent highs sit buy stops from breakout traders. Below recent lows sit sell stops from late longs protecting profits. Smart money is not interested in direction until liquidity is accessible. And right now, silver is hovering between those pools like a market waiting for permission. This is where many retail traders misinterpret what they are seeing. Sideways price action at elevated levels is often labeled as weakness or exhaustion. In reality, it is frequently preparation. Institutions require liquidity to enter and exit efficiently, and liquidity does not exist in the middle of ranges. It exists at the edges, where emotion is highest and risk is most concentrated. On the intraday and 4-hour charts, subtle signs of this behavior are already visible. Short-term market structure breaks have occurred, not to reverse trend, but to rebalance positioning. These micro breaks flush out impatient longs and aggressive shorts simultaneously, creating clean zones for re-entry. Price then returns to equilibrium, leaving behind footprints that only make sense if you are watching for them. Fair value gaps have begun to form beneath current price, particularly in areas where impulsive moves originated. These inefficiencies act like magnets over time, not because price must fill them immediately, but because they represent zones where institutional orders were left partially unfilled. When price revisits them, it often does so with purpose, not hesitation. Order blocks tell a similar story. The strongest bullish reactions over recent weeks have originated from narrow zones, with minimal time spent trading within them. That is a hallmark of institutional involvement. Retail-driven moves tend to be messy and prolonged. Institutional entries are precise, fast, and defended aggressively once revealed. What makes this phase especially deceptive is the absence of dramatic volatility. There has been no waterfall liquidation, no parabolic spike. Instead, silver has been rotating within a controlled range, absorbing liquidity on both sides while maintaining its higher time frame bias. This is the kind of environment where false breakouts thrive, and where traders focused on direction alone often find themselves repeatedly mispositioned. Pay close attention to how price behaves near equal highs and equal lows. These are not coincidences. They are engineered reference points designed to attract liquidity. When price approaches them, volume increases subtly, spreads tighten, and reactions become sharper. This is where decisions are made, and where the next multi-week move is often initiated. Another detail that should not be ignored is time. Significant moves in silver historically do not occur randomly throughout the day. They cluster around specific sessions, particularly when London and New York overlap. Recent price expansions have respected that pattern, reinforcing the idea that this is a professionally managed market, not a speculative free-for-all. All of this points to one conclusion that is uncomfortable for many traders. The market is not waiting for confirmation from indicators. It is waiting for liquidity to be fully harvested. Once that process is complete, direction becomes obvious in hindsight, but difficult to anticipate in real time unless you understand the mechanics behind it. The most important takeaway from the chart right now is not where price has been, but where it has not been allowed to go. Despite multiple attempts, deeper pullbacks have been rejected quickly. That tells us something about risk tolerance. When markets are overextended, they invite correction. When they are preparing, they resist it. Still, no market moves in a straight line forever. The question is not whether silver will retrace, but how and from where. And that brings us to the final layer of this analysis. Because once liquidity objectives are met, and once structure confirms intent, the path forward becomes a matter of probability rather than speculation. In next section, we will map out the forward scenarios that matter most from here. Not predictions, but probability-weighted paths. We will examine what confirmation actually looks like, where invalidation would occur, and how traders and investors can think about risk without being emotionally pulled into the noise. Because the next major move in silver will not announce itself loudly. It will reveal itself quietly, just like the story that brought us here in the first place. At this stage, the question is no longer whether silver is important. The question is how this market resolves the tension that has been building beneath the surface. When price reaches historically elevated levels while structure remains intact, outcomes narrow. Markets either confirm strength through continuation, or they expose excess through controlled rebalancing. Both paths are informative, and neither should be approached emotionally. The first scenario is continuation through acceptance. In this outcome, silver holds above its most recent high-volume zones and continues to defend higher time-frame support. Pullbacks remain shallow, liquidity below current price is only partially tapped, price resumes its advance once positioning resets. This is not a euphoric breakout scenario. It is a grind higher marked by consolidation, measured expansion, and repeated confirmation that demand remains in control. Historically, this is how sustainable trends extend. The second scenario is a deeper retracement designed to rebalance participation. In this case, silver temporarily trades lower to address unfilled inefficiencies and reclaim liquidity resting beneath recent structure. This move would likely feel uncomfortable, even convincing, to those positioned late. But structurally, it would remain constructive as long as higher time frame levels hold. These types of pullbacks are not failures. They are resets that often precede the most directional legs of a move. There is also a third, less discussed possibility. A prolonged range where price does very little, but positioning changes dramatically beneath the surface. In this environment, volatility compresses, frustration builds, and participation declines. Yet this is often where institutions finalize exposure quietly. When resolution finally comes, it tends to be decisive, catching the majority of participants unprepared. What matters most is not which scenario unfolds, but how price behaves as it approaches key levels. Confirmation is not a headline, it is acceptance. Rejection is not a single candle, it is follow-through. By watching how price interacts with liquidity, structure, and time, clarity emerges naturally. This is where patience becomes an edge. Silver is not a market that rewards impulsive decisions. It rewards those who can wait for alignment between macro context and technical confirmation. Right now, that alignment is forming, but it is not complete. And that incompleteness is precisely what makes this phase so important. From a broader perspective, silver's role is evolving. It is no longer treated solely as a speculative commodity or a secondary precious metal. It is increasingly viewed as a strategic asset tied to both monetary conditions and industrial necessity. That dual identity creates complexity, but it also creates opportunity for those willing to understand it. As this story continues to unfold, the most valuable skill will not be prediction, but interpretation. Markets communicate through behavior, not promises. And silver's behavior right now suggests intention, not exhaustion. If you've stayed with this analysis to this point, you're already doing what most participants do not. You're looking beyond price alone. You're asking why, not just where. That mindset is what separates reactive trading from informed decision-making. In the days and weeks ahead, the levels discussed here will be tested. Some will hold, some will fail. But none of it will be random. Every move will leave clues for those paying attention. If you want to continue following this story as it develops, consider staying connected. Future updates will focus not on noise, but on structure, probability, and context. Because when silver makes its next decisive move, it will not just reflect a change in price. It will reflect a shift in how capital is positioning itself for what comes next. And often, by the time that shift becomes obvious, the opportunity is already past.